So what if I told you that there have been no trade deals announced between the US and its major trading partners other than the UK, that Chinese tariffs are going to be between 20 and 50% in perpetuity, that the Fed has no intention of cutting interest rates, and that a war has broken out between Israel and Iran over Iran's nuclear program? If I told you all that, would you expect the S&P 500 to be positive year to date and just 2% away from an all-time high? Me either. But that's exactly what's happened. And it's confusing a lot of investors, and rightly so. I mean, seemingly every day we have some sort of chaotic or negative headline that's on the top of our browser or phone. Yet the market doesn't seem to care that much. Why is that? Well, I'm going to explain why. Let's start with trade and tariffs. There have been no trade deals other than the one with the UK and some sort of a general truce with China. But the July 9th reciprocal tariff deadline is just now a few weeks away. So why don't markets care more about all this trade, tariff uncertainty? Well, the answer is because they don't think it will last. I'm sure you have seen the acronym TACO, and we all know what that stands for. But do you know why it's so important? TACO is important because the idea that the administration will always back down from crazy tariff threats allows investors to generally ignore all tariff and trade commentary. Think of it like your parents threatening a crazy punishment. You know they're not actually going to go through with it, so you can largely ignore it. Obviously, that's a simplistic analogy, but it's not that far off. And that's why the market is able to look past 50% tariff threat on European imports or some other wild threat of trade or tariff sanction. The market believes the administration will back off if those policies are harming the economy. And so far, they have been right. And that is the main reason that markets are higher despite all this trade and tariff uncertainty. Now let's take a look at the Fed, right? At the start of the year, investors expected the Fed to cut rates 4 or 5 times this year. Now we may be lucky to get 1 cut. So why isn't that a problem? Why isn't that hurting markets more? Well, because it doesn't appear the economy needs Fed rate cuts, at least not yet. If interest rates are stable, but the economy is doing fine, then why does the Fed need to cut? Sure, I mean, it'd be nice for stocks if they just cut even though growth was solid, but that also could potentially boost inflation. So until the Fed needs to cut rates, the market doesn't really care if they do cut rates. Now, let's turn to geopolitics. Why isn't the Iran-Israel war causing stocks to decline? I mean, this is something that global powers have tried to avoid for nearly a decade, and despite their best efforts, it has happened. So why aren't stocks down more amidst fighting between these two major countries? The answer is oil. So whenever there's a conflict in the world, it doesn't matter if it's in the Middle East or anywhere else, oil is the barometer for markets. Not to sound insensitive or coarse, but unless a conflict is making oil prices spike, markets generally don't care. And that is the case this time as well. Over the past several years, sanctions have largely decimated Iran's oil export business. And so they are no longer a major player on the global oil stage. Meanwhile, Saudi Arabia is trying to expand their market share in global oil, given competition from the US and others. And so they're ready to supply the market with more oil if needed. Yes, oil prices have risen somewhat given the conflict, and rightly so, but not nearly enough to impact the markets and the economy. So until oil surges, probably above $80 a barrel and higher, the conflict will not impact the markets. Finally, let's turn to the economy. Economic data is finally starting to show signs that the economy is losing momentum. Whether it's the monthly jobs report, weekly jobless claims, the ISM PMIs, retail sales, durable goods, we're starting to get a bit of a laundry list now of numbers that are coming in under expectation. So, since investors were terrified of a recession earlier this year, why don't they care now that the data is starting to point towards a slowing of momentum? Well, because the data isn't bad enough to make them care. Yes, we have seen some softening from these and other economic indicators, But right now, it's not clear if this is softening that could be part of a soft landing in the economy, or this is the start of an economic slowdown or stall. And markets don't tend to front run slowdowns, they react to them. And so until the data gets bad enough that the market needs to react to this data, it won't. In the end, this is a very confusing time for investors. I mean, it's, again, seemingly every day we have a chaotic headline or a scary trade or geopolitical threat, yet the market continues to be resilient. And that's a good thing, but there are always reasons why. And that's why you have to get good research. It doesn't just tell you what's happening. It tells you why it's important and how it could or could not impact markets. The need for that research is only going to get stronger over the summer, because while investors are suddenly quite complacent, the risks to this market are not subsiding. Consider this. On July 9th, all the reciprocal tariff delays expire, so we could see much higher tariff rates on all of our global trading partners in less than a month. Now, markets don't expect that's going to happen. That's the taco principle. But what if it does? Or what if it partially does? Similarly, nobody expects economic growth to suddenly nosedive, but most honest people are acknowledging that it is weakening. What if we see a dramatic acceleration in the slowdown as people finally get tired of all the policy chaos? Similarly, what if the conflict between Israel and Iran expands? Nobody assumes that's going to happen right now, but there could be escalation that does impact oil prices. And if that occurs, the market will react negatively. Finally, this hasn't been a big focus, but we have a fiscal situation in the United States. The debt ceiling is coming due in early August. And if we get another dramatic showdown in Washington where we go to the 11th hour before extending it, that will inject further uncertainty into the markets, and that will hit stocks and bonds. Bottom line, the market is resilient, and that's certainly a good thing. But don't confuse its resiliency with a very strong and calm macro environment. It is not a strong or calm macro environment. And there is ever-present risk that one of these issues do become bad enough to impact the markets. And given current valuations, there is very little support for stocks unless we see a 10% or more decline. So pay attention, be ready for volatility, and make sure you have the research you need to successfully navigate this environment. Thank you for watching. And if you'd like more market insights, please click the link below for your free 2-week trial.